Okay, so one of the questions I keep getting asked in the comment section is how to structure a stock market portfolio for long-term success. And that's exactly what we're going to be talking about in today's video. So the way we'll do this is I'm going to break this down. I'm going to walk you through this step by step and explain to you how I structure my own portfolio. And we're going to talk about how to organize it by different categories and different types of stocks. I'm going to break down what all the different types of stocks are, what to look for when hunting those stocks down. I'm going to explain how many stocks I think you should own and what, like how much as a percentage. I'll even give you examples of different stocks that I think would meet certain criteria, so that we kind of end up with a blueprint on how to structure a very well-rounded and diversified portfolio for long-term success. So definitely a very educational video, especially for beginners. And I hope you guys enjoyed, and hit the like button if you do, please. But let me know down in the comment section what other video you would like to see next. But with all that said, we got a lot to cover. So let's go ahead and dive straight into this. Okay, now to keep things simple, we'll break up our portfolio into three primary sections, those being foundational stocks, middle stocks, and spec stocks. But for middle stocks, we're actually going to break that down a little bit further into three subcategories that will include stocks focused primarily on dividends, overall value, and overall growth. And I'll break down what each of those means and how to pick those stocks in just a second. But let's go ahead and start now with primary category number one, which is foundational stocks. So what exactly are these? Well, I like to think of these as very solid and highly reputable companies, usually with very large market caps and definitely with very stable financial performance right now, but still very bright futures to look forward to as well. So these end up being like the glue that holds your entire portfolio together. They're usually a lot more stable, and even when they dip or go through any volatility, it should just be like an automatic reaction to just buy more of them because they're such amazing companies. The only con is that they may not see explosive growth just because they're already such large companies. But again, that's not really what we're looking for here. We just want reliable stocks that act as building blocks for the rest of our portfolio. And because of that, we're going to need a very large foundation here, and therefore I think at least 4 to 5 foundational stocks is necessary, and they should be around 7 to 10% each, so that you end up with a very large grand total of around 30 to 50%. And I would do closer to 30% if you want a higher risk, higher reward portfolio, and then closer to 50% if you want some more stability and a little bit less risk. And by the way, I actually keep mine closer to 50% just because I really love my foundational stocks. I like them so much that even at a higher percentage, I actually still feel like I can make a lot of profits from them. So that's why I keep it so high. But here's a pie chart just to kind of illustrate what all of this might look like as a percentage. Now, to give you some examples of what these stocks might look like, well, as most of you know, my absolute favorite and number one largest stock in my entire portfolio is of course Microsoft, who, if you look at a 10-year price chart of them, they are literally the definition of stability with one of the smoothest uptrend charts in the entire market. And that's because of extremely solid financials. I created this chart here of the past decade to show you their revenue and net income, and you can see how they consistently generate tens of billions of dollars each and every single year without fail. Other stocks I either own or would love to own as foundational stocks would include things like Facebook, who has a gigantic social media empire with one of the best balance sheets in the entire market to get them through anything. Google, who is very similar to Facebook but also has their hands in just about everything in the world right now. Definitely Amazon, who is the world's largest e-commerce and cloud computing giant. And I'd even include some smaller but still very dominant companies like Visa, for example, who's practically always been a market leader in credit and debit cards with a proven track record and a still very promising future, especially in digital payments. Okay, now moving on to part two, that's going to be our middle stocks. And for these, I think around 5 to 10 stocks is good for beginners, but I personally go around 10 or even higher just because there's so many to choose from, and I really like my portfolio being very well rounded across the 3 different subgroups that we'll take a look at in just a second. But as percentages, I think around 3 to 10% is pretty good, but I would stick closer to the bottom range there just because we do have so many different stocks to choose from in this category. But as a grand total, this section should be around half of your portfolio, and I would try to stay below 60% just because you do want to leave enough space for your foundational stocks as well that we just covered. So I usually stick to around 50% myself. Now, this may seem like a lot, but again, you have to remember that we're dividing this section into three subcategories, and those are dividend, value, and growth oriented stocks. Now, you might be lucky enough to find stocks that kind of meet all three subgroup criteria, and even your foundational stocks might also spill over into any of these as well. And of course, that's totally fine. In fact, that would actually be ideal. But just to better visualize what we're looking for here, I'm going to explain each of these and give you some examples. So, starting with dividend stocks, first and foremost, you want them to pay reliable dividends, because if you're investing in a company almost entirely for the dividend, then you want to be confident that it's not going to just like disappear on you anytime soon. So you'll need a stable business with substantial cash flow to keep the dividends coming in the future. You're going to want a large growth history, meaning that they've paid dividends consecutively for many years and continue to grow them. You're going to want some growth potential in the dividend with a low payout ratio, meaning the amount of profits that they spend on dividends is low. And you want that so that you know that they can keep growing them in the future. And finally, you're obviously going to want a meaningful yield as well, so that you're not just kind of wasting your time with tiny profits that won't really do much for you. I generally like my dividend focused stocks to be around 3% or more on the yield. Now, you're not always going to find all of these qualities in a single dividend stock, but some good compromises, for example, might be something like PepsiCo, which is one of my favorite dividend stocks, since they not only have a very solid and profitable business, but also carry a whopping nearly 50 years of consecutive growth on the dividend and still manage to yield about 3%. A couple of trade-offs though are that the yield is a little low and the payout ratio is high at almost 75%. So for a lower payout ratio, perhaps something like Johnson & Johnson would be another good option, whose payout ratio is much lower at about 50% and is still a market leader with very strong profitability and an even higher growth history of almost 60 years. So, very likely that they'll keep paying that dividend in the future. They too have a fairly low yield though, at less than 3%. So let's move on now to the value category, where I actually have some high yield dividend stocks to show you. Now, when looking for value stocks, I like to focus on three specific aspects. Number one, you obviously want to start with stocks that are trading for a cheap price, what we call the value. And to keep things simple, we'll just focus on the most commonly used valuation metric, which is the PE ratio, the price to earnings ratio, which tells you how much you're paying in relation to the profits of a company. And ideally, you'd like that number to be significantly lower than things like the broader market, some of its competitors, or just the sector average that it operates in. Number two, I recommend that the company is, of course, solidly profitable, because a cheap price usually means that the company is struggling or is expected to struggle in the near future, and thus having solid profitability will make it much more likely that they survive the storm and are able to adapt and invest in ways to perform better in the future. And then number three, the company itself should, of course, have a business that you believe in. Remember, you have to be very careful with value stocks because they're usually trading cheap for a reason, and you don't want to accidentally buy the stock of a dying star that will eventually collapse into itself and lose a lot of your hard-earned money. That's why I try to keep these at lower percentages just in case. And then just one bonus criteria that I want to throw in as well is that it probably helps if the stock actually pays a dividend as well, because value stocks tend to be boring companies without a lot of growth, and therefore a solid dividend can be a great way of ensuring that you continue to make profits even if the stock isn't like a really big high flyer like what you might see in growth stocks, for example. Speaking of dividends though, AT&T is a value stock that does seem to fit most of the bill right now, as the stock has been falling for years due to the decline in legacy cable TV and landline telephone subscribers, but they still generate plenty of free cash flow from their wireless business that should see future growth with 5G, while their new streaming service HBO Max Max may recapture some of those lost cable TV subscribers, and yet the stock trades over 50% cheaper than the sector median on a non-GAAP forward PE ratio basis, while also paying out a monstrous dividend of over 7.5% with over 35 years of consecutive growth. Ignore the number there, seeking alpha glitches. I believe it's like 36 years right now of consecutive growth. Now, something like AbbVie would also be a similar story, as the loss of patent protection for some of their pharmaceutical drugs has sent the stock crashing in recent years, despite the fact that they've made moves like acquiring Allergan to ensure their really high free cash flow continues to pour in the future. Still, the stock trades almost 70% cheaper than the sector median, despite paying out a very large dividend of about 5.5% that has been grown consistently for almost the past 50 years in a row, if you include the years that they were a part of Abbott Laboratories. Okay, and then finally, to offset the lack of growth that value stocks tend to experience, it's usually a good idea to throw some growth into your portfolio as well. And for these, it's crucial that you stick to companies with a solid business that you believe will have a very bright future thanks to whatever products or services they sell. And of course, it helps if those products are sold in a growing market that does make it easier for the company to get larger and larger over the long term. Quick word of caution though, be very careful with valuations on these, because investors aren't stupid. If a company has a lot of growth potential, then they're going to buy the stock early and drive up the price, leaving you with much smaller gains and more risk over time. So I usually do most of my buying on these type of stocks whenever they experience an individual dip, or when the overall market corrects or crashes and ends up dragging them down with it. For example, I did pick up Tesla during their crashes, and now I'm up close to 1000% thanks to their amazing growth, which you can see on this chart here that they're even expected to grow sales this year by over 20% despite us going through a horrible recession, and then another 40% the year after as well. And they really check all the boxes, with great management led by one of the world's best CEOs in Elon Musk, great products with the highest performance electric vehicles in the world, amazing brand strength and customer loyalty under the Tesla brand name, and a solidly growing business that operates in one of the highest growth markets in the world in electric vehicles. The only thing that this stock does fall short on is, again, the super high valuation, with a forward P ratio of over 100 right now, which is why I say that the absolute best times to buy these type of stocks is when they're actually going down, not up. But sometimes buying up can be good too, so it's just a little bit of a balancing act. Okay, now with all that said, we have almost our entire portfolio built out now across several different types of stocks, but once in a while you might like to get a little risky and maybe take a chance, and that's where spec stocks come into play. Now for me, I almost never go higher than 3 stocks with spec stocks, with the percent of each only being around 0 to 5%, and to be honest, most of the time each of them is actually less than 1% of my portfolio, just because they can be so risky. But as a grand total, I always try to stay well below 10% of my portfolio, and again, to be honest, most of the time I'm like less than 3%, although I have gone higher on occasion in the past. Anyway, the reason I'm cautious with these is because spec stocks are just that. They're speculative, meaning you're not really investing in a solidly run and profitable business, but rather gambling on what they might be able to do in the future. Now, most people categorize these as unprofitable companies that lose a lot of money, but I would even expand that definition to include companies that only recently started being profitable as well, or that are very young, because that means that they won't have a big track record of profitable success, so you're left having to speculate on whether it'll continue. Also, I would even go as far as to include companies that you just don't know a lot about, or you haven't really spent enough time researching them and going in with as much depth as you probably should have, but maybe the stock recently dipped and caught your attention, and you're worried that it's going to take off on you before you can do all your research. So in that case, you might just want to buy a very tiny amount just to have it, and then research it over time while you own it, and then decide later whether you want to buy more or sell it or keep it or whatever else. I would throw those type of stocks into this category as well, even though that is a much more kind of rare thing that happens, but I've actually done it myself a couple times in the past. Anyway, having said all of that, there are actually a few stocks in my portfolio right now that I do consider to be very speculative, so let's just quickly run through a couple examples. One is definitely Carnival Cruise, who, as you probably know, has been absolutely destroyed this year because of the pepperoni forcing cruises to be canceled until things get under control. And I went ahead and bought some of that, and it's currently less than 1% of my portfolio. But I don't have plans to buy any more at this time, although I probably will continue to hold it just because they used to be a very profitable company as one of the world leaders in the cruise industry that also paid out a very nice dividend. And if they're ever able to make a comeback, then I might be able to make a nice little profit off of it, which, by the way, I'm already up about 50% just because I bought so low anyway. So that's why I just kind of continue to hold it. Now, another stock that is almost identical to Carnival would be Delta Airlines, who is also a market leader in travel, but they too suffered a horrendous crash this year because of the pepperoni, and so I have virtually the same kind of tiny gamble on them at less than 1% of my portfolio. And finally, there's also Glue Mobile, who is actually my newest addition to my portfolio, and unlike Carnival or Delta, who both used to be profitable until the pepperoni hit, Glue Mobile actually just recently started to turn a profit, so not much of a proven track record there, but they're definitely headed in the right direction and they operate in the extremely high growth mobile gaming market. So I did decide to take a chance on them after their most recent drop. Okay, so add up all the different sections and we're probably looking at a portfolio that would typically look something like this: about 45% for foundational stocks, around 50% for middle stocks broken up into dividends, value, and growth oriented stocks, and then just about 5% for some spec plays as well. Okay, so there you have it, guys. I hope you enjoyed the video. A little bit of like a blueprint for you guys on how to structure a portfolio. I hope you found that useful, especially if you're a beginner. One quick thing that I do just want to add though, I didn't really cover this on the video, but you should obviously diversify across different markets and sectors too. I didn't really touch on that because I feel like it's common sense and I didn't want to waste a lot of time covering it and make the video very long. But obviously, you shouldn't just be owning like bank stocks or pharmaceuticals or automakers or travel stocks or whatever else. You should be spread out a little bit because different sectors will perform differently at times, and you might find better deals in different areas too. Like, say you're looking for more growth or more value or better dividends, you might find those opportunities in different areas at times. So it's just a good idea to not have all your eggs in one basket. Although I will just say though that if you do feel like you're more experienced in certain markets, then I do think you should invest a little bit heavier in those just because you will understand the businesses and the products a lot more. And I think that'll lead to making wiser investment choices. But overall, you should still be kind of diversified overall. So anyway, I just wanted to quickly touch on that. I hope you guys enjoyed the video. Thanks again for watching. Thank you for the support. Hit that like button if you enjoyed it. And I'll catch you guys in the next one. Take care. Thank you. Bye-bye.